Good evening. We're Team IIFT and we're here today to present our findings and support our recommendation on HT Media. But before we begin, I'd like to introduce members of the team.
I'm Piyush.
I'm Shashank.
And I'm Pranay. We initiate our coverage on HT Media with a buy rating at a target price of Rs 124, an upside of 39% on a market price of 88.85 as on the 11th of April 2014. Our optimism, it stems from the fact that HTML has a diversified portfolio with a good mix of mature and emerging businesses. We've identified 6 key factors that have a material impact on HTML stock performance and will revisit these factors during the course of the presentation. These are growth in the Indian print media industry, a shift towards duopoly in Mumbai, continued growth in local advertising, an inflection point in India's most populous state, Uttar Pradesh, Phase 3 radio licenses, and a diversification in business mix. Let's begin first by setting a context, both in terms of what HT Media does and how it's placed in the industry. HTML is the second largest and a 90-year-old print media company, home to 3 newspapers, the Hindustan Times in English, Hindustan in Hindi, and Mint, which is a business daily. In our analysis, we have classified HTML's businesses into 5 distinct units. Let's take a look at the revenue. English print contributes nearly twice as much as Hindi print. But what's interesting to note rather is the revenue CAGRs of these businesses, with Hindi growing at 14% as opposed to 8% in English. And this ties in with our macro trend of continued growth in local advertising. Even though education, radio, and internet currently contribute less than 14% to total revenues, we expect them to play a more pronounced role in HTML's future. A split of revenue by source makes it immediately apparent that there is an over-dependence on advertisement revenue at 75%. And with this in mind, we set out to analyze the total spend in print media in 2013, which was 163 billion INR, of which HTML captures a little over 10%. But to get a clearer picture, we split this 163 by language, and what we found was rather interesting. In the English print market, HTML has access to 67% of the total spend via Hindustan Times in Mumbai, Delhi, and Mint. And in the Hindi market, it has access to 47% of the total spend via Hindustan across 5 states. To summarize, HTML has access to 40% of the total ad spend, even though it has a very selective geographic footprint. With this in mind, we move on to what is the crux of our presentation. Why should you buy HTML? We've summarized our findings into 4 arguments to support our recommendation. 1, the stability that Hindustan Times brings to HTML. 2, the growth being driven by Hindustan. 3, HTML's decision to diversify into higher margin and emerging businesses. And 4th, valuation, which reveals that not only is the stock attractive from a growth perspective, but also from a valuation standpoint. Argument 1. The English print market has strong fundamentals, but lacks exceptional growth drivers. Circulation revenue projections are fairly flat, and ad revenue growth is well below the industry CAGR of 11%. So why then do we look at HT in positive light? We believe that the answer lies in the nature of the industry. Print markets in India are best characterized as a duopoly, and this is great news for HT as it finds itself in the top 2 across its offerings. The Delhi market is a perfect duopoly with the Times of India and Hindustan Times. HT Delhi serves as a proverbial cash cow and a bedrock for future expansion. In Mumbai, HT has consolidated its position as a strong number 2. We expect this market to follow a J-curve profitability, with HTML beginning to reap disproportionate benefits due to its increased market share. So what we're saying really is that Hindustan Times has just reached a sweet spot after significant investments and a long gestation period. And we expect it to consistently beat industry averages purely on the back of it being the top 2 across its product offerings.
Now let us look at argument number 2, which is the growth story of regional print in India. We interpolate that a combination of higher consumption growth, rising literacy level, backed by an increase in income level, has led to a higher allocation of ad spend to non-metros by advertiser. The trend, we believe, is here to stay and is reflected in expected 13% CAGR. Hindustan HTML's Hindi offering continues to dominate Bihar and Jharkhand with readership share of 50% in these markets. These states have a combined population of 130 million. Revenue growth to be driven by ad yield improvements apart from launch of new edition. Uttar Pradesh is estimated to have a print ad market of rupees 10 billion, the largest market for Hindi print. Its readership share in Uttar Pradesh has increased from sub 10% in 2005 to 19%, reaching number 3 position in this market. We believe Hindustan is reaching an inflection point in Uttar Pradesh, driving ad volume improvement. To summarize, regional print is where the action has moved to in India. And hence we argue that even though Hindustan was launched in 1936, it is only now beginning to show significant growth opportunity owing to a changed macroeconomic environment. Argument number 3. As part of HTML's effort to reduce overdependence on print, it is now entering into new emerging businesses which present higher margin and high growth opportunity. Going forward, the radio, digital, and education businesses of HTML could add significant value to its portfolio. HTML radio station Fever 104 continues to dominate 4 metros. Currently, the industry is characterized by muted growth, but it is expected to change after the phase 3 auction of licenses and grow at a CAGR of 21%. Fever 104 2 is likely to reap the benefit by expanding into Tier 2 and Tier 3 cities. In digital, HTML operate online job portal Shine.com and HT Campus. It was also the first media company to enter the mobile solution space. It has also ventured into education with Management School in joint venture with Apollo Global and has launched StudyMate in partnership with Mahesh Tutorial. In our view, HTML's success in long run will depend on how they manage to successfully scale up operation in these businesses.
We have arrived at a valuation of rupees 124 using a combination of DCF and multiples approach with a 70-30 weight distribution. Let's begin with our DCF model first. With a WACC of 12.6%, a PGR of 4%, and a debt equity of 0.27, we have arrived at an intrinsic value of rupees 116. Our sum of the part analysis indicates that Hindustan contributes rupees 45 and Fever 104 rupees 9 to it. Moving on to valuation using multiples. We have used a range of 3 multiples in a football field analysis to arrive at a target price. The mean multiple of the peer set with equal weightage assigned to all 3 valuation ratio leads us to a stock price of rupees 143. Compared to its peers, HTML is trading at a discount of 35% on 1-year forward PE and 40% on 1-year forward EV/EBITDA. Over the past 8 quarters, the company has underperformed its historical PE of 14.14x and is currently trading at 8.9x. So what do we know now? HTML is trading at a significant discount compared to its peer set by PE and EV/EBITDA, at a 31% discount to our target DCF price, and at a 37% discount to its historical sell by PE. All of this points to one thing, that the stock is undervalued. The only question that remains now, is it the right time to invest? With the stock recently recovering from its 52-week low, and as our analysis suggests that a turnaround for the company is in order, we believe that it is. Based on our financial analysis, we conclude that HTML has robust financials coupled with strong earnings growth. HTML is expected to have healthy cash flows driven by Hindustan Times in Delhi and Hindustan in Bihar and Jharkhand. We do not see any significant capex apart from potential radio licensing expenses. The company has a low leverage ratio, and going forward, it is expected to reduce further. Newsprint, 50% of which is imported, is a key component of the cost structure and averages 32% of revenue, is also expected to stabilize. Rising readership multiple and improving ad yield is driving the revenue growth of the company. More important, however, is the increased contribution of higher EBITDA businesses, up from 14% currently to 21% by 2018, resulting in an EBITDA margin expansion of 400 basis points. The EPS is also expected to nearly double to INR 14.91 by 2018. Key risks to our investment rating include HTML's inability to acquire adequate licenses in the upcoming 2014 auctions, a shift in consumer preference towards consuming news online, and as our analysis suggests that a 1% increase in newsprint prices will have a negative 2.3% impact on EBITDA. And yes, we also looked at corporate governance, where we compared HTML to its listed peers across 6 key parameters and did not find any major area of concern there.
And with this, we conclude our presentation. The 6 key factors that we identified right at the beginning have helped us define 4 arguments to support our recommendation, and our valuation model leads us to a target price of 124. In fact, the recent Indian readership survey results that were released less than 2 months ago have further strengthened the force of these arguments. Thank you so much for listening, and with this, we're open to questions.